Welcome to TheoTrade. This is Don Kaufman. In this video, we're going to give you a bit of an introduction to vertical spread. So at this point, some options knowledge is going to be quite useful, but if you don't have substantial options knowledge, or you're just simply newer to trading options or newer to even the idea of spreads, I think you're still going to get a huge amount out of this kind of segment here on this, again, introduction to vertical spread. So first and foremost, I've gone ahead and I've selected an underlying. I'm going to use Tesla. And the reason I'm using Tesla, it's known to be kind of a wild child in the marketplace. So, we could use an expiration anywhere from 6 days to 13 days to 21 days to 28 days. I mean, you name it, it's there. But I don't mind explaining things using weeklies. Like, don't be intimidated by weekly options. I use them for many, many examples. As long as it's liquid, trade it. So here we have 35 days remaining to expiration. And again, Tesla's a fairly liquid product. Here's some options with no days to go. They're going to expire today, and they're trading thousands and thousands of contracts. So I look out here 35 days prior to expiration, and one of the major mistakes that you see a lot of traders make when they first go out and they start trading options become really alluring because you're like, oh, I do not have to buy a $234 product. I can go out there and I can buy me what? Some calls. Okay, and I want to stick with calls in the example because, again, I think the most part it makes it easy. But what a lot of people do, they'll buy at the money calls or slightly out of the money calls. And there's actually an introduction to probabilities video that gets into the how and why and the reasons for not buying calls, but I'm going to give you a good one. I'm going to go down to options, theoreticals, and Greeks, go to probability in the money. And if you buy, for example, these 240 calls, and I'm going to highlight and kind of enunciate this, but if you buy these 240s, that ultimately is your probability, not of making money. It's about a 40% chance that these 240s are even going to be in the money. Okay, for you to make money, you don't need a 240. You need a 240 plus the $9, which is 249. Listen, it's off like the screen there, at 249, and that's just to be able to break even. And if somebody said to you, like, hey, you got about a 25% chance of getting your money back, you might not like that. So enter the vertical spread. And what is the vertical spread? So to kind of kick this off, what I'm going to do is I'm going to use what's called an in-out spread. Now, there's umpteen different ways to use vertical spreads. You can sell vertical spreads. You can buy vertical spreads. You can sell out of the money vertical spreads. You can buy out of the money. Okay, out of the money, that's stuff out here. In the money, that's stuff up here. The shaded region is in the money. Those are options that have what? Intrinsic value. Intrinsic value. That's real value. Out of the money here, it's what? Nothing but air. These options have nothing but time value. So an in-out spread is I'm going to buy an option that's in the money and sell an option that's out of the money. It's just one of the many tools I use. And I'm going to build it, then I'm going to explain it. So in this case, I'm going to go ahead and right-click on the 232.5. So I'm going to go to buy, okay, and all the way up to vertical. Left click on vertical, and immediately on the thinkorswim trading application, it'll populate a vertical spread. Now, the vertical spread that I've brought up, okay, and I'll show you the option chain at the same time here. It's the 232.5, 235. It's just a $2.50 wide vertical spread. And right now it's trading for about $1.33. This is a live market. We're open today. It's bouncing around a little bit. Doesn't matter, all right, so much about the price of the spread, okay, but you're looking at the stock. It's up, it's down, it's all over the place. The spread is trading for $1.33. Now, on the spread, what have I really created? Okay, well, I went out and I bought these 232.5s. And again, I'm going to freeze the screen and kind of enunciate a few things, okay? I went out and I purchased this 232.5. Okay, why did I do that? Because I wanted them. Okay, and they're trading for almost $12, and that's some serious capital that you're going to be putting up over there. But then I turned around and simultaneously sold okay, the 235. So if you're new to options, buying, okay, these 232.50s gives me the right to buy the stock $232.50. Selling the 235 obligates me to deliver somebody's stock at 235. So what happens if the stock runs, for instance, to something crazy like 300? You're like, oh man, I mean, it's Tesla. It could happen. 70-point move. Oh, crazier things have happened in Tesla. Okay. Stock runs to 300. It's okay. I have the right to buy the stock at 232.5. Somebody else has the right to take stock from me at 235. What's the most I can make? The most I can make in a vertical spread is the difference between strikes. In this case, it happens to be no more than $2, okay, and 50 cents. Now the trade, you usually have to pay $1.33 for. You have to pay $1.33 for. Now, well, you only pay $1.33, but the most you can make is $2.50. You're like, I don't know if I love that. Man, I don't know about this, Don. Now, if you actually look at the trade, it had even bounced down to, okay, $1.25. And I'm actually going to put the price to $1.25 because it makes it kind of easy to understand. You risk $1.25 to be able to make $1.25. Now, again, in this introduction to spread, this is what I want you to take away. Don't worry, okay, so much about the structure of the spread. There's umpteen different free videos here at TheoTrade, and there's umpteen different classes that we'll build that'll talk about every nuance of this trade. Okay, the one thing I'm going to tell you about spreads, they're not what you think they are. Okay, they're about risk management. It's not about windfall profitability. It's about risk management. If you know going into a trade, and now the spread's trading for $1.23, but if you know going into your trade, okay, that your maximum risk is $1.25. I mean, that's it. The max risk in this trade is $1.25. Do not ask me if you need a stop order in this trade. Who needs a stop order? Why would you place a stop order on something that only has $125 of risk for one contract? Or if you even did 10 contracts, $1,250 of risk plus the transaction cost. You don't need no stinking stop order, okay? The idea of the spread, it makes you impervious, okay, to risk. You know what the risk is. If you don't like the risk, don't do the trade. And that's the point that everybody misses. They look at, well, I can only make $1.25. That's 100% return. And the stock only has to go to 235, okay, or better to be able to do that. 235? Like, really? It's Tesla. The next 35 days, you don't think it can do that? All right. You know what this stock has done over time? Okay, here's Tesla. Well, it was all the way down to 210. It's all the way up to 230. Oh, but it was recently at 260. I mean, it's all over the place. Okay, maybe bullish isn't right for you, so don't do the bullish spread. You could do a bearish version of this trade. Again, what I want you to do during this introduction to vertical spreads is I want you to be enticed by the risk management factor in here. Not about I can make 100%, you know, but yeah, but you can also lose 100%. You have to understand that this trade makes you kind of impervious, again, to that risk. For the next 35 days, you can hold a trade that only has, okay, $1.25 of risk. Now, don't run out based on this. Don't run out based on this and just start firing off vertical spreads, because there's so much more that you can learn about these things. Like, do I do it for 35 days? Okay, why not do this trade instead of for 35 days? I could actually do it for what? The Jan 2s. The Jan 2s have a lot less time, right? There's 21 days. Or I could even go out to like March. I could go all the way out to March, and March doesn't have 250 strike increments. It has $5 strike increments. So in the March trade, and let's do it. Let's just build a March trade and see. This is a $5 wide spread. I can go to buy and over to vertical. And in this case, here's a $5 wide spread for about $2.50. Maybe you're bearish. If you're going to be bearish, why would you be buying a call spread? Maybe you buy a put spread, okay? And again, all I'm doing is scraping the surface. Here's the put spread, $5 wide put spread for $2.43. All right, you got to understand both sides of the marketplace to be effective in a marketplace. Whether you're bullish, whether you're bearish, again, giving you an introduction to spreads, I just, again, want to entice you to all the different variety that's open over here. You know, one of the things that people always say is like, you know, the further out you go, the more the options are going to cost. That's not true. It's not true if you know how to spread off the time value. You buy one option, sell another option. You can actually negate time value. You can negate all the volatility risk. Somebody says, don't buy options, volatility is too high. That is ridiculous. Because if you know how to use the spread, you'll negate volatility risk. You'll negate the time risk in there. If you know how to use these spreads correctly, okay, you mitigate your risk from the get-go. You don't have to use stop orders. You don't panic when the market moves against you. And that's a lot of what we do here at TheoTrade.